Good evening members, welcome you all to the CP session on TP documentation. May I request CA Nagaprashanth to escort the speaker onto the dais and welcome you to collect photo bouquet. For today's session, we have CA Prashanth here with us. A brief introduction about the speaker. He is a chartered accountant with over 22 years of experience. He has completed his BCom from Bangalore University. He has also completed diploma in systems audit. He is a certified international taxation practitioner, a graduate of law from Hubli University. He specializes in indirect and direct taxation, especially in domestic and international taxation. He was the finance and taxation head at UB Group of Companies. He was also heading a central monitoring team at Arvind Group of Companies. Coming to his certain publications, he is a co-author of book on international taxation published by KSCA. He is also a co-author of book on GST, Where Did My Profits Go? He is a speaker at various forums like ICI, DTRPI and various other professional forums. He has presented papers at various forums in Delhi and also at ICI chambers in Bangalore. Also at regional conferences. He has done VAT implementation for various clients at Dubai. With this brief introduction, welcome you, sir. Over to you.
Everyone, am I audible?
Yes, sir.
So when the topic was decided, Lata ma'am was asking, why is it that we have chosen the topic now? So I said, the tax returns are through, transfer pricing certification is done. So the only thing that is left for us during the season is to complete all the TP documentation. And she asked, how did you do TP certification with the documentation? Correct? We need the TP documentation, based on which we should sign the Form 3C. Now, the entire challenge is that to do the TP documentation, you need the comparable companies. So you need benchmarking. In order to get the benchmarking, we rely on the transfer pricing databases. The databases gets updated based on the company's data they purchase from each of these companies, and they update the database. And all the audits have got over only September, October, November. Correct? And by the time this database comes and it is now fully updated, we are in December, right? That is the reason that the TP documentation activity happens now. Now the challenge is, how did we do Form 3C then? The provisions allows us to use the previous 2 years average data, check the margins, based on which you can still issue the transfer pricing certificate as such. So it is something like, it is not closure of a TP document ever. It is always transfer pricing documentation in the making. And in the making to an extent that it keeps on going till the time the transfer pricing officer calls you for the TP documentation for assistance. It never ends. Why is that? It is not a pure maths, not pure arts, pure science, nothing like that. It is capturing the actual business scenario, combining it with the provisions of the law, and finally establishing the fact that the transactions between related parties are at arm's length. So when this exercise has to be done, there are several things that has to be taken care. Of course, when we go through the slides today, we will understand that. And for understanding of the participants here today, I have an Excel file, I have a Word file which has TP document. As in when we go to that stage, we'll just go through them as well. Now, when it comes to the maintenance of the TP document, there is always a challenge. The clients would ask us, you have done the TP documentation for financial year 22-23. We started the business then. 23-24, again why are you doing the TP document? 24-25, again why are you doing the TP document? So the documentation has to be on yearly basis because assessment is done for the specific financial year, specific assessment year, correct? So the numbers has to get updated in the TP document to make it relevant for assessment of that particular year. For that reason, the transfer pricing documentation has to be invariably done for every financial year. Of course, we have a turnover limit that has the transaction limit that is there in the provisions, which says in case the transaction is more than 1 crore, then you maintain TP documentation, otherwise not necessary. But there also we have a challenge. As a chartered accountant, when we are signing a Form 3CEB, with what backup documentation can we sign the 3CEB, say if the transaction is say only 50 lakhs? Does it mean to say that entire documentation that is prescribed there, I would overlook that and still sign the certificate until the arm's length transaction is established? Not possible. So, at least in those cases, I tell the clients, even if the transactions is not more than 1 crore, finally it's me who is going to sign the certificate. So I need a backup documentation based on which I have signed the certificate. Hence, if not a comprehensive TP documentation, at least an abridged form of TP documentation should be there, which covers the computation of the arm's length price, the margin computation. We will see the benchmarking study, at least the benchmarking portion we will include, right? All these things has to be part of it to make it appropriate as such, right? So, why I went into directly transfer pricing documentation is that I assumed some of the basics you would have already known. I assumed it. But based on the need that we may have for today's discussion, I have got the slides for the basic provisions of the law as well. And we will see which direction it takes based on how fast we'll be able to catch this. Okay. So when it comes to the transfer pricing work as such, can I understand here how many of you are already doing? 1, 2, 3, 4, 5. Now 6-7 people are there. So looks like for the rest of us, some basics of the transfer pricing has to be there. And then we go into the documentation part of it. So those of you who are experts of transfer pricing, so for 30 minutes, bear with the provisions. And after that, we'll go into the provisions as such. The TP documentation. In 2001-2002, the government realized there have been several MNCs which are starting operations in India. As a result of that, obviously they came to India because either the material or the labor or the business conditions was commensurate for them so that they can take advantage of scale and lesser cost in India. As a result of that, they can do the businesses in their respective countries and book higher profits in their respective countries. So obviously we are at that stage, we wanted more people to have employment, of course now as well. But that is where the capital or the money will move from a capital-rich country to a country where capital is required for development. Simple. So when the money moves, there is an investment, there is business, there are operations that are taking place. But the operations, when they take place, are they disclosing correct profit, what it is supposed to be in India, so that Indian government can collect right taxes from their operations in India? So where is the question of right taxation not being there? The possibility is that in case there is transaction between a foreign entity, a parent entity and a subsidiary in India, or a head office or a branch in India, or a sister concern outside India and another concern in India, if the pricing or any other mechanism or the terms of agreement are designed in such a way that the profits can be shown less in India and they can move higher profits to a different country. What is that country? We can discuss later. By doing that, the taxable profit in India, if it comes down, then the tax collection to Indian authorities are low. Hence, there is a need to ensure the transactions are at arm's length. And arm's length transaction is the value that basically is supposed to take place between two unrelated parties. This conceptually is very important because next when we discuss, there are scenarios where we see that we are trying to take a transaction as a comparable transaction and somebody may question, is this transaction a tainted transaction or a related party transaction? If so, it is unfit to be a comparable and hence you cannot use the transaction that you are trying to compare with, whether it is arm's length or not. Correct? So that is why it is important to understand related party transactions, unrelated party transactions. And related party transactions, the objective is to ensure whether it is at arm's length. If it has to be at arm's length, the income tax law goes on to tell that it has to follow certain provisions of the law. So the business dynamics are so varied and different. Actually, you cannot tell in this transaction at this point of time, this is the price. Not at all possible. So it is something like every transaction, a related party transaction is happening. Is it possible for somebody to do an assessment, identify, okay, is it at arm's length or not? You can understand the complexity. If there are 100 transactions during the year, assume some 4 transactions a month. So every time a transaction happens, or maybe some 10 transactions a month, I'm sorry. So every time a transaction happens, will you sit and see whether it is at arm's length? Correct? That is the requirement of the law. The law is telling it has to be at arm's length. If it is not at arm's length, then other provisions of the law can apply, wherein the transfer pricing officer can call for assessment and he can make adjustment to the pricing to arrive at the correct profit. Now the correct profit, we don't know whether that is the profit what generally a business earns or the profit that the assessing officer wants so that he can collect more taxes. That is the reason where transfer pricing becomes a very, very complex subject. Doing everything looks simpler, but then when we enter into it, it becomes very complex because not much about the law. It is more to do with how we are going to handle the business scenario and present it better in ATP documentation is what going to give an advantage to you later in the transfer pricing assessment as such. That is the reason transfer pricing documentation is important. In a regular case, it may be simpler. For example, a IT, software, ITS company, generally we see what are the steps, various things are there and it will go on. But there may be several other transactions which will certainly have quite a few challenges to handle as such. So in the sequence of these provisions, this is what the law has prescribed on the definitions and understanding of the transactions, etc. It uses the word any income, section 92, arising to associated enterprises And associated enterprises, there is a definition in section 92A. From an international transaction. So to the associated enterprise, there is an international transaction. From there it is getting income. So what is international transaction is there in 92B. International transaction shall be computed having regard to arm's length price, A and B. So what is arm's length price? Is there in 92F. 92C and D is there, we come to little later. So nicely the provisions have been laid out, and that again, it is a very simple thing. If you are a related party and you are doing international transaction, the transaction should be at arm's length price. And if you look at section 92, it comes under the chapter heading where the income should not be avoiding tax under the income tax law, because this is a deterrence mechanism to ensure that Indian government does not lose the income tax. From that perspective, the law has been enacted in this section. Associated enterprises, it means direct or indirect participation by way of management, control or capital. Predominantly from these three reasons. At any point during the year, this is very interesting. So the relationship on April 1st of the year is not there. On September 30th, yes, there is a relationship established by any of these criteria, management, control or capital. 31st March, relationship is not there. But during the entire financial year, whether it is prior to September or post September, all transactions that are done between these related parties come under the provisions of the transfer pricing law. So, and what is this participation in management, control or capital? The law says by one enterprise into another enterprise, there is management, control or capital, or by the same person in both the enterprises, by way of management, control or capital, there is a participation. By way of both any of these conditions, two parties can become related party. Associated enterprises. We not call it related party, it is associated enterprises. And we are using the word enterprise and not a company, because we have to take under this gambit the individuals, the firms, the LLP, trusts, what all and what not. And it will come to. And if you carefully check any income arising to AEs, it is saying associated enterprises. Here also, if you see, it uses the word enterprises. Nowhere it is talking about resident, non-resident and all that. So if there is an associated enterprise outside India, but it has a transaction of income or expense in India with a related party, the income, if it is arised in India, based on section 9. So you have section 9, 1, 2, 3, 4, 5, 6, 7, 8, right, which tells which are the scenarios where income is deemed to accrue or arise in India. So section 9 gives that framework. So under that, any of the non-resident enterprise is getting taxed in India. Mind you, that also is associated enterprise. So many times it so happens we end up doing compliance for the Indian entity, but if for the foreign entity, if you have done a withholding of tax, you are trying to tell that there is an income element taxable in India to that foreign entity, and hence you have done withholding of tax, so that foreign entity has to file tax returns here. And because it is associated enterprise transaction and there is no distinction between to whom this is applicable, the foreign entity also has to get its Form 3CEB certified by a chartered accountant. Right? So the definition and the coverage of the provisions as such is quite wide. Quite wide to ensure that any income that is getting generated in India, that has to get properly taxed. That is the objective based on which a very comprehensive definition has been given here. This picture invariably is only saying that how the intercompany is related, either directly or indirectly, or through one or more intermediaries in the management or control or capital of other enterprise, shall be regarded as associated enterprise. So in this case, if you see A transaction with B, A transaction with C, A transaction with Inter Limited, and Inter Limited transaction with C Limited. This is how a transaction or an investment structure can be there. Okay, we will come back to this. Now, because of the relationship that exists between these entities, the transaction with Inter Limited will be subject to related party transaction, that is the associated enterprise. These are definition sections. We will not have so much time to cover them. So I'm just trying to give you the heading so that you can recall this when you're just going to refer back the provisions again. So there is 92A1A and 92A1B based on the management control and so 92A and 92A1B, either between the entities there is a management or control or capital, or same person is having management control or capital. So 92A, 92A1B. This one becomes much more interesting. It is 92A2. This becomes deemed associated enterprise. Now the point is, if I look at 92A, 1A and 1B, two enterprises, I may come to a scenario where I can tell that they are not related at all. So the transaction should not come under transfer pricing. But yet, there is one more set of provisions carved out in the law where they are saying there are some transactions with enterprises where those will cover those as related to transfer pricing provisions by grouping them under deemed associated enterprises. So they are saying, when is that? There is a common participation in capital greater than or equal to 26%, loan contribution greater than or equal to 51% of book value of assets, guarantee given greater than or equal to 10% of borrowings, appointment of more than half of the directors, say a person has that power, dependence on know-how, patent, etc., supply of raw material greater than or equal to 90%, firm AOP or BOI having greater than or equal to 10% of existence of mutual interest in the entities. Relationship at any time during the year, it is sufficient to constitute such relationships also as associated enterprises. This is deemed associated enterprises. First, when we saw 92A and 92A, it is associated enterprises. These, although 92A and 92A1B does not satisfy, but any of these satisfies. Even those comes under deemed associated enterprise definition. So associated enterprises, in crux I have already told this, so we will not go too much in depth in this for the want of time. You can go through the provision. It is once the associated enterprise point is clarified, so we know who are going to transact between them, are they associated enterprise or deemed associated enterprise. Next we try to test whether it is international transaction, because transfer pricing applies only if it is international transaction. So what are international transactions? So it can be a purchase, sale of tangible property or intangible property. It can be lease of tangible property or intangible property. Providing services, providing financing. It can be cost sharing or cost contribution arrangements as well. I am a multinational company. I have presence in 80 countries. In each of the 80 countries, if I go and buy Microsoft licenses, it will have different costs. Instead, I go to Microsoft and tell, I have 80 countries, each country requires 1000 licenses, so give me 80,000 licenses. For 80,000 licenses, I'll pay you once and hence give me a better discount. As a good businessman, this is a better logic, correct? But once I buy as a parent entity, that 80,000 licenses I am supposed to distribute to all my associated enterprises. So the entire cost of 80,000 licenses as a parent entity, I cannot absorb the cost. It has to get distributed to each of those entities which are using those licenses, and hence a cost sharing or a cost contribution arrangements arise. All of us have seen this in day to day. So even those arrangements are classified under international transaction, and then they say it has to get arm's length. What arm's length? We'll come to that. So these international transactions will have bearing on profits, losses, income, assets or liabilities. So if these transactions have any bearing on income, profit, losses, income, assets or liabilities, then it becomes international transaction. Otherwise, no. Existence of prior agreement between an unrelated third party and AE of the entity, and terms are determined in substance by the associated enterprise for undertaking transactions with such unrelated third party. They have entered into the agreement transaction. Now, the first portion, international transaction, is 92B1, which is a plain definition 92B1. Now we have one more element in international transaction. It is called deemed international transaction. Interesting. First we saw associated enterprise, 2 ways there. Then deemed associated enterprise. Now we saw international transaction. In international transaction again deemed international transaction. When does this happen? The transaction may be with some other party, which is a non-associated enterprise, by say the Indian entity. Example. But the transaction that the Indian enterprise has to transact with non-AE, independent party, the pricing for that or the terms of the agreement for that is already decided by the parent entity. And although there is no direct transaction between parent entity and the Indian entity now, but parent entity has the influence of the pricing or terms of agreement with non-associated enterprise, the transaction between Indian entity and non-AE also is coming under deemed international transaction, even if it is taking place in India. That is interesting because it is done in such a way that there can be an element of shifting the profits to foreign entity by entering into an arrangement with non-associated enterprise, telling that per piece to me you charge $1,000, to Indian entity you charge $5,000. In that way also the parent entity is able to reduce its cost there and retain higher profits. But the Indian entity by way of this may result into lower profits or in fact can be losses as well. And this is the prerequisite why the lawmakers thought that deemed international transaction also must be defined, and that also should come under arm's length pricing principle. It is making sense? Is it very complex? Okay, we will do one thing. We will just make you free for 2 minutes. In case you have to ask anything in this, let us discuss that. I have a lot of people today, so I'll see in case I can learn new things and go. We'll just take break for 2 minutes, just think over. In case you're getting anything, any parallel thoughts in this or any other questions, we can try to discuss that. Then I'll go to the next one. No? Very boring subject. when we deal with law, it will be boring. That you cannot tell. We'll go to preparing KP document, it will be interesting. That is why that I have kept in the second half. These days, no, something special must be there in second half, otherwise the 3 hours movie does not run. So the benchmarking KP document, I have kept it for the second half. So you can tell me on the law part, should we discuss anything here? Or is it clear? It is okay? Can I move forward?
Can you explain also this?
Which part?
Deemed international transmission.
Okay. So we can see this example, it will be easier for me. So there is XYZ Inc. USA and we have ABC Limited India. XYZ Inc. is holding company, ABC Limited is subsidiary company. So primarily based on holding and subsidiary itself, it became an associated enterprise. So the left hand portion is clear. Then XYZ USA has prior arrangement relating to quantity and price of goods with a non-associated enterprise, which is outside this group. It does not belong to this XYZ ABC group. It is PQR, somebody else. And if you see that dotted lines, above that is outside India, below that is in India. So in our example, we are trying to say non-AE is in India only. It is in India only. ABC Limited is purchasing goods from non-AE. That is, non-AE is selling goods to ABC India. So although the transaction is within India, because there is a prior arrangement between XYZ and non-AE, within India transaction also has been told to be international transaction, and hence the deeming fiction created telling that it is deemed international transaction. Why is that? You are in Karnataka, you are buying from Andhra, but Andhra entity is already influenced by the US entity. Now Andhra entity is going to raise invoice to you in INR. You will pay it and you will buy your goods. But the quantity and pricing is already determined by the foreign entity. You and non-AE have independently not drawn the terms of the agreement. Hence there are chances that this can be tainted. By way of telling, okay, as a non-AE, when you are giving me, give me $1,000, you charge $5,000 to India. Correct? So this needs proper assessment so that correct cost should be allowed as deduction in India. And hence, this has been brought under deemed international transaction. Make sense? There are methods of computing arm's length price. So when it comes to arm's length price, we are telling two people are there is a distance of 1 arm. So at that distance, if I give the price, it is arm's length. No, it is just given as a relative word that has been used here. But there are several parameters that goes into seeing whether something is arm's length or not. So how do we do it? As I told you, there are countless kinds of transactions that are happening across the world and in India, right? How will we obviously tell, take one transaction, compare this and compare both and let me know whether it is an arm's length. Not that easier. So, as per the principles that is laid down in the international taxation, and of course, there have been several commentaries that are available in OECD as well, and the international transfer pricing concept that have been used in several countries prior to we adopting transfer pricing, it was already there. We combined all those methods and we are using them. To just read from here, it is comparable uncontrolled pricing method, in short, CUP method, resale price method. So CUP is price method, resale price method. Okay, these two are trying to directly compare price with the unrelated party transaction. This is direct comparison. So it's probably the most sought after methods, but not that easy. So, the law has come up with cost plus method, profit split method, transaction net margin method. These three are talking about profits. We'll come to each of them, but it is talking about profit. So at the price level you are not able to compare. Okay, compare entities at profit level. So there are two broad categories of transfer pricing methods. We should classify them as pricing methods, profitability methods. Right? Then, as always, we are a very, very special country. There is other method. So there has to be something different as a country that we are doing. So it is other. Just for sharing with you, I have to say, not recently, at least 4 or 5 years back, I went through the statistics. In India, only on transfer pricing, if you see, the total litigation that is there, per year, 75,000 to 1 lakh crores is the transaction values which are being questioned. That was some few years back. Today, if I see, it will be multiples of that. I can't even put, because even if you take a individual company, it is having some 30,000 crores, 40,000 crores. So the values have gone up multitude times. And invariably in all those top companies, the case is picked up for transfer pricing suit. And it goes on and on. Either you get a transfer pricing order, then the assessing officer confirms it, he raises a demand, then you have option to go to dispute resolution panel, that is the DRP, or go to Commissioner of Income Tax Appeals. If you go to either of them, you go to DRP, you can't go to CATF. If you go to CATF, you can't go to DRP, because both are at commissioner level only. And once order is passed there, you go to ITAT. Then if there is any question of law that is left, go to High Court, then to the Supreme Court. So you can imagine each case, each assessment year, by the time it gets settled, we are looking at a time period of 6 to 7 years elapsed. That is the important need in the country probably to increase the appellate authorities, the courts, the judges, as in any other legal requirement, in tax as well, we have probably very urgent need. Otherwise, a lot of things are just stuck in litigation. And all of us know when it gets stuck in litigation, at least around 20% of the taxes we pay and it is in the stay matter and it is stuck. Right? So you can imagine the amount of TP litigation that is there and the demands that are raised, and 20%, 10%, 5%, whatever stay you've taken, and that money is lying with the central government. That becomes the working capital. So TP assessment can also be a working capital strategy. Otherwise, how do you explain? Company A is information technology company. Company B, information technology enabled services, ITS. TP order is passed for A, go to B, sometimes you will feel same order as coming. Right? How is it possible? So, many times it has been a method to garner more tax revenue so that it can lie in litigation space that forms typically the working capital for the central government. But that requires a lot of refining, retuning, getting into more sophistication, or I should say more robustness in the entire appeal process as such. I mean, we are in the making, so I suppose all those things will happen. I just mentioned there because the kind of assessment orders an assessing officer can pass. If I can make a mention, Indian assessing officer. Nobody else in the world can do it. So there are some international tax conferences that happens, Europe, US, all that. You attend any of them, you'll feel great. I've come to this foreign country. I'm looking at lecture of a foreigner, and he's going to talk international taxation to me. Let me learn better here. We go on, sit. He goes on talking about a lot of principles, what is happening in the world and all that, and he'll come to the litigation space and he'll start quoting the case laws. Nearly half of them will be from India. So you feel that I left India, came India, and again seeing India here. That is the kind of innovative assessment orders that we get in the country as such. And that is what it makes very interesting for the subject to be, because you know what is the risk, you know what the client is going to undergo on a later date. You have to work backwards and see today how better can I keep the TP document and what kind of workings can I have, what kind of documentation can I have in order to ensure that tomorrow when there is litigation, I have a better case to present, not just for winning, even at a basic case when you are presenting for a stay of taxes. You have to go and convince the principal commissioner there and tell that, look, this order would not hold good in the court. In way the department is going to lose. I understand you are told, as per 1912, 1914 circulars, whatever is there, 20% I have to pay taxes. Please look at my case, this is the documentation I have. They are going to anyway lose it. Please allow me to pay 5% of the demand. Allow me 2% of the demand. Allow me 10% of the demand. So, based on this documentation, you have at least negotiation space. You are able to understand why all these are required. At different levels it is required. Of course, if it is not done, that is a separate thing. We'll come to the penalties. That is the separate thing. But the basic thing, you are issuing a certificate, there should be a backup. You need a document. You are fighting a case, you have to show the TP document. Next, litigating. On the TP document only there is a litigation. Very interesting. On the topic today, if you are thinking, how important is it? How important is it? You will be shocked to see the entire case on the transfer pricing, is on what? On the TP document only. Assessing officer says the assumptions that you have made, the workings that you have done, it is not as per the TP principles that is laid out in the law, and he will give some 10 reasons. And he will tell, as a result of that, your TP document is rejected. Look at the way he forms the TP order. He will tell your TP document is rejected. Okay, my TP document rejected. So what? Now he will tell, as a result of that, based on the TP provisions, let me compute your arm's length. And he is computing your arm's length. That is how he is going to project. Tomorrow when it goes to ITAT and somebody tells your TP document is rejected, you have two choices now to fight. Either you have to defend your TP document, or the basis on which he has done the working, you have to repudiate. Even then you have to come back to TP document and try to defend why you are right. That is the reason the topic today becomes very important. So it is at various stages we see why TP document becomes relevant as such. And in that document only these methods have to be mentioned. Important composition of the TP document is the transfer pricing method. Because out of these 6 methods, you are going to corner or you are going to choose one method which is better than the rest to prove that what transactions you have done and what values you have adopted are at arm's length. You have to establish the fact, right? You have to tell that your transaction is at arm's length. So among this we choose one and we tell that is most appropriate method. So first one, as I said, it is pricing method, so it is called traditional transaction method. Then it says transaction profit method. Then the other one. The law then tells us, out of the method that you have, at least in one method, prove that your transaction is at arm's length. This is the crux of the transfer pricing. Out of the methods that you have, under any one method, you prove that it is at arm's length. And that obviously becomes most appropriate method. On the other hand, this is from assessing. Go to the assessing officer level. He may say, you have taken cost plus in this, No, it is not possible for these reasons. I will go for transaction net margin method. The entire workings goes for a toss. When I tell the workings goes for a toss, mind you, it is not just going for a toss. You'll understand the amount of working that is involved. When I go to the Excel file, I'll show you the amount of workings that is involved. So we need to understand here, there is no hierarchy or priority of methods as per the Indian TP regulations. What we saw here is only a listing. They are told the 6 methods are there. But they are not told first to exhaust that, then you come here. They are not told that. So there is no hierarchy. Regulations provide for selection of the most appropriate. MAM shall be method which is as per rule 10C1. It says it is the method you should read with. It is best suited based on the facts and circumstances of the international transaction. Which international transaction am I seeing? Okay, so based on that I'll choose the method. I'll come to examples, you'll understand, but just hold this for a while. Which provides most reliable measure in relation to the international transaction. Because you must be able to measure also, not just theoretically. What are the factors for the most appropriate method? So all these are contained in Rule 10C. Nature and class of the international transaction. Purchase involved, sales involved, goods involved, service involved, royalty involved, interest involved. What is the nature? Class of enterprise and FAR. What is FAR? It is not how far, it is functions, assets, risks, analysis. Then availability, coverage, reliability of necessary data. Availability. First I need to compare. There should be one more data. If it is not available, how will I use that method? Not possible. Coverage. Is it covering sufficient amount of transactions or the respective, say, financial year? For example, the transactions have taken place in 23-24. You have got a pricing list of 22-23. Comparable? Not comparable. Reliability of necessary data. So somebody was carrying a price list and he dropped it. I'll pick it up and tell, I've got the pricing for these products, I'll add this. Possible? What is the reliability of the data? Has it come from some source that we can rely on as people of some general maturity, as basic understanding? If I am importing, there are DGFT and customs records which may be used. There are databases that are required, we'll come to that. Those databases have got some level of approval in the income tax department. So I can use them. Reliability. So the data should be reliable, otherwise it is not comparable. Degree of comparability between international transaction and uncontrolled transaction. What is the degree of comparability? Why comparability is required? Here you are selling in Indian conditions. When some goods goes outside, you have international markets, demand supply problem, logistics problem, storage problem, funding problem, correct? Foreign exchange problem, correct? Based on all this, you are not going to retain the same price of the product that you are selling in India. You will cover all these things and tell, okay, because of these risks, my 100 becomes 125. Otherwise, these risks I cannot cover. So, an international pricing with domestic pricing, how it will become comparable? It cannot. So it says, degree of comparability between international transaction and controlled transaction. If I have to arrive from 125 to 100, logically can I put each of these factors, give a rate of adjustment to that and arrive at this price and still show is it at arm's length? Can be a methodology. Can be a way of computation. Method is only those things. Extent of reliability, accurate adjustment. nature, extent, reliability of assumptions required for application of the method. There are some assumptions that we have to invariably make. When we are looking at them, we will see them. No one method is suitable in every possible situation, nor is it necessary to prove that a particular method is not suitable under the circumstances. If you are able to prove, that is sufficient. But invariably, as a TP document, we have this old traditional method where we put a method and tell that why this is not applicable to it. And then we go on to arrive at that specific method and tell in the TP document why this method is applicable. So that is how TP document is finalized. Fine. We will come to the methods now. That is the CUP. In this method, it compares price charged for property or service transferred in controlled transactions with price charged in comparable uncontrolled transactions. I think we can have some 2-3 examples here. So we are talking about the very simple definition, example that I gave, product A, or say television. Okay, let us make it easier. It's a television. When I am exporting, what should be the price? When I am selling locally, what should be the price? It is an uncontrolled transaction. With foreign entity, it is related party, but Indian sale is an uncontrolled transaction. Correct? So, it is saying compare the price charged for property, that is television, transferred in controlled transactions, transferred in India, with price charged in comparable uncontrolled transactions. What is done with foreign entity? That is controlled is related party transaction, with price charged with uncontrolled transactions in India. We have several factors based on which it is not comparable, and hence we can't take it as comparable. Instead, what do? The same entity has a transaction with unrelated party outside India. Now it becomes comparable. But there also challenges arise because your associated enterprise is in USA, your uncontrolled transaction party is in Germany. Now the price that you use for your product in US can be different for the price that you use for your product for your customer in Germany. Because there again there may be several legal issues, business dynamics, logistics, funding, or it can be all reasons based on which those two prices also need not match. Make sense? You need not sell same product, same price to say Germany and USA. Again it may fail the comparability test. But if I have same country, at least irrespective of whether it is West Coast or the East Coast, I can at least tell it is USA. So I am trying to compare. There it becomes much more comparable. It requires very high standard of comparability. Most direct and reliable way to apply arm's length principle, but can be used in case of similarity of product and services. If there is minor change, either in the product or in terms of agreement, it cannot be compared. Correct? Conditions for use. None of the differences between transactions can materially affect price in the open market. Then only you can use this. Reasonably accurate adjustments can be made to eliminate the material effects of such differences. Only in these two exceptions you can use the CUP method, although there are differential prices. You are able to tell that, okay, there are no differences, so you are able to use it. Or you are able to make that adjustment to the price to prove that, yes, we are right. Then only you can use the CUP. So as I told, this gives the finest evidence for the transfer pricing as such. Of course, we discussed on the product, assume service is there, and in the service, normally when we look at technology services or IT services to be simpler, you are fixing the pricing based on say FTE or based on hourly rate, right? Now the point is hourly rate from company to company may be different for the same service. Possible? Because I have a different cost base, he has a different cost base. I am in Bangalore, he is in Shimoga. Costs are different. So I can afford to have a different pricing based on my location, my costs. There also it is not easy to tell that per hour rate I can match. It becomes quite challenging. So comparability as such, there are broadly internal comparison, external comparison. So what are internal comparison? The tested party, that is say in this case the Indian entity, to whom you are doing the transfer pricing exercise. You are testing its transaction. That is having transaction with a related party and also an unrelated party. It becomes a internal comparison because both documents relate to you. You have two invoices. Price is mentioned there. It is your own invoices, not some other party's invoices. Correct? So that comes under internal comparison. But you have a pricing going on independently in the market. There is separate purchase order or invoice that is available, and you don't know how the competitor is able to share it with you, or some purchase order you have taken from an external party. That becomes an external comparison. So both internal and external comparison has been upheld. You can use either internal comparison or external comparison for comparison. So you know what challenges you can face in the cup method. So the pricing becomes quite tricky. We may go to resale price method, but before that we are just coming one step back. We are taking wages going to cost plus method. So in the cost plus method, basically it is trying to test what is the gross profit margin of the product. So for the products that you are selling and your competitor is selling, or say non-associated enterprises dealing with, can we see what is the gross profit margin? Is it available in the first place? Why will somebody come and tell you this is my gross profit? Take it. Are you able to perceive the challenges that we will face? Gross profit of the product, how will I know? It is not possible. In many cases it is not possible. So for these reasons as well, cost plus fails. But cost plus will still work in a case where you are taking data from the database. So there are some databases that are there where company information of financials, that is the profit and loss account, balance sheet, is given there along with notes to accounts, etc. So from the database when you are picking, there are certain workings that they do in the database and make it comparable. There is an effort that goes to create a database. It is not easy. So you will take those numbers and then compare the gross profit margin between two companies. Okay. Come to GP margin of your company and then see, okay, am I near that or am I equal that? We'll come how near, how far, we'll come to the position, but we are trying to compare at that level, at the gross profit margin. That kind of a comparison comes in the cost plus method. So you can just imagine in your mind it is gross profit for simplicity. So normally for gross profit, what do you take? You take direct cost, indirect cost. Operating expenses includes everything else, so we just park them aside. Arrive at the GP. Same formula you use for comparable company also. Then arrive at, on the same basis you have arrived at GP, and this is the GP margin of the tested party and also the comparable company. Then you try to match. So if it is same, assume right now we will use the word same. If it is same, it is a constant. How much same will come to that. Then we come to resale price method. This also in a way indirectly cost plus method only. But the nature of businesses which gets covered here are those where there are some back-to-back transactions. Something like manufacturer is there, wholesaler is there, dealer is there, final consumer is there. So back-to-back when I do the transaction, at each level, normally, what is the margin that I keep? So that margin again is nothing but my gross profit. So invariably RPM and cost plus method both looks at gross profit. But cost plus method normally under percentage terms RPM in value terms, because you are comparing price. So price A to price 100 to price 120, difference is 20, correct? You are comparing price level, cost plus GP percentage. You are comparing GP percentage is same, okay, and then at price level it is same. That is the difference between cost plus method and resale price. In RPM also it can be internal comparable, external comparable. Because you can have your further associated enterprise where you are a manufacturer or a wholesaler, somebody within the AE group is a retailer. Possible internal. External, somebody that I am dealing with is an external party. I have those pricing as a comparable to test with the internal party. Internal, external, possible in RPM as well. GP we discussed. Then we have a method called profit split. So what do we do in profit split method? There are 10 countries where the operations are happening. So there are 10 profit and loss accounts. I consolidate them and remove all the related party transactions. Okay? Normally you just knock off, right? Your inter-aid adjustments between H1 brands, the way you do it, sale purchase you just knock off and purely arrive at unrelated party sales and unrelated party costs, arrive at your profit and loss. Based on that, you are actually arriving at the true profit of the entire group. That comes to 100. Now that 100 I have to split between 10 countries, because in these 10 countries I have my A's. So when I split that, I need to arrive at a basis on which I am splitting the profit. That is the profit splitting. That profit directly I take, put it in Indian computation and tell this is the profit on which I am supposed to pay the tax. That is profit. Not again easy. Between one country to another country, comparing price and margin itself, we are doing a lot of exercise. Imagine the amount of activities that will be there in each country, and again you have a problem. There are several economic factors based on which everything is happening. So there is a lot of subjectivity already embedded. In some country rentals may be low. In same country rentals will be different. So anybody arguing from the assessing officer side, for example, he may tell that, you are trying to consolidate all the profit, but economies of scale or the economics of that country or the interest rate of this country or forex situation of this country is entirely different. So I don't want to adopt this, it is complex. We'll drop it. But these are the reasons why these methods over a long period of time have unfortunately failed. In cup method, at price level there is nothing for me to compare, because I don't have directly any purchase order or invoice for me to compare, either the goods or service. At cost plus, it goes into gross profit. Normally we don't like gross profit, we don't know why, because none of us can exactly match what is direct, indirect, what is overheads. What is direct, indirect, what is overheads, always all of us fail. So income tax officer also fails. So that also fails. Profit split has this economics problem. Many times that also fails. That is so of course, coming back to PSM, we do the workings using, we split the profit based on functions, assets, risks. Functions, which entity is doing the purchase function, which country is doing the production function, which is doing the marketing, which is doing the sales, which is doing the capital investment, which is getting the funding, right? So for each of these activities, what is appropriate to have the proportion of the overall profit of 100? You can see the subjectivity embedded in this. Very difficult to derive the profit of it. I think, I'm not able to recall immediately, but I think it is a car case. racing car case, Ferrari or something. No, not that. I think there is one more brand. Let me recall that. So where the court held, the Supreme Court held, a marketing sale is a very important activity. We would like to attribute 30% of the profits to this. What is the basis? Not easy to derive. So again, subjectivity. Somebody is trying to inbuild confusion in the method that we are using. So again, for this reason it fails. But we still use functions such as risks and try to allocate. In service company, we use number of people and the cost and say our labor. I can have a basis like this to split the profits. Service company. Because all my costs and revenues are normally associated to the people. So I can use that as a basis. But for the limitations that I mentioned, there is a problem there. This also fails. This slide is only, we are trying to tell, first determine the total profit of the group, allocate the profit to each component of the group. Here. And because of all these reasons, finally we have a residual method, that is the transaction net margin method. So as the name signifies, it is almost the net profit. And why am I telling it is almost the net profit? Unfortunately, the word used is net, but the margin that is compared is the operating profit, operating margin. When it comes to operating margin, you have a challenge. What is that? So that means to say you are working, the non-operating items has to be removed, whether it is income or it is expenditure. So for that matter, interest income, if I earn based on FT that I have kept because of my surplus funds, that interest income I will remove in order to compute my profit. Otherwise, it goes to increase the operating profit. It increase the profit. I am trying to tell that yes, it is a transfer. No, they won't agree. They are telling take the operating profit, so move the non-operating item away. You have funded the company based on capital, no problem. You borrowed a loan. For the loan you paid interest. Interest is a financing activity and not an operating activity. Our cash flow definition, we have operating, investing, financing activities. Interest is a financing activity, not operating activity. So from the operating profit, I cannot have interest. I have to pay. So we do these adjustments when we do the TP workings as such. And then arrive at the operating profit of the company for which you are certifying and also of all the other comparable companies. And all these comparable companies, from where do you take? You take from the databases. And most prominently used by the income tax department is the Progress database. Although we see capital line also is used. One more approved database is the ACE TP database. That also sometimes used. There is a mechanism to do it. We arrive at the operating profit margin. Take the comparables companies, take their operating profit margins, make a table and do a statistical function and arrive at a median. And that median is the margin that you have to beat to tell that your arm's length price is established. So that is how the entire thing works. So how we go about doing the tracking is coming after the break. Related parties and international transactions, the transfer pricing functions and the arm's length should be there. So we went on to see who are associated enterprises, deemed associated enterprises, international transaction, deemed international transaction. Then we saw what are the methods. So we went through almost 4 methods. Fifth method, variant transaction net margin method. Predominantly because this method is used in several assessments. We are trying to see here how to compute the arm's length price, how to substantiate arm's length price by using transaction net margin. That is very easy. We also understood there is something called as a progress database or a capital line database or a ASTP database, from where we get the company's information so that we can pick up the comparables from there, the profit margins from there and try to compare them. How do we do it? Is where the spreadsheet exercise will start. Is this visible? Is this visible now? Better? People are there at the back, so I'm just checking. Is it visible? So in this example, we have used two databases, Provis, ASTP. And this working we have done for software services. So what is the search strategy that we have employed and what are the steps we have taken to do the search? We'll go through from here. So this is not some research or that is not there. Simple method. What does transfer pricing officer do when he passes the order? Simple. Take that order, make that as the steps that you have to follow for preparing your ticket document. More simpler. There is nothing great that we have to think. How we go about doing, we'll do. But I'm telling the basic thing for us to understand is, finally you're doing all this because transfer pricing officer has to agree to it. So normally how is he doing it? So take the TP order only, start from it. And this is how he does mostly, almost 90% will match, 10% will not match. That is where we and a TP officer always fight. So we'll reach there, we'll understand there is a problem. So if you look at the strength of this database, Provis IQ, it has universe of more than 54,000 companies available in Provis IQ database as on 6th November 23. I have not taken the current database and given you the TP document right now because I have not completed any TP document as of today. It is in the WIP, so I thought I will not show you any WIP, finished product only. However, for comparable analysis, we have considered the financial data updated till 26th October 23 only. Look at the amount of documentation that we are talking about here. So the officer can tell, look, 6th November 23, you already have a database that is there, but financial data updated till 26th October 23 only you are taking? Yes, because there are certain companies which had to still come and it did not come, although it is maintained till 6th November. But the additional information what they got into database, the final update for the companies that we already have in 26th October 23, all updates were already done. So we did not want to take any more risk telling that what is not done and try to take that and finally result will be something else when transfer pricing officer runs the report. So we are disclosing to the transfer pricing officer, this is when we did it. 1. 2. There is also an ulterior motive. What is the date on which you should file Form 3CEB? 31st of October. So I am told by 31st of October only so much was updated. You are trying to get the reasoning here? Because if he takes up to 6th November, it is anybody's guess, another 250 companies, another 2000 companies he'll add. He is trying to attack my TP document. So I am trying to defend it. I am telling, yes, you are attacking my TP document, I understand, but I have taken the companies up to 26th October that is available in the database and that is what the provision of the law is telling. I am following it. Based on your logic, don't reject my TP document. So I am trying to put these dates and keep it as a working file with me so that tomorrow when there is an assessment, on the basis of dates, he is not contending any of my workings as such. You are able to understand the logic? We have selected all companies from IT software industry. Of course, there is a drill down that we get, or a search query box we get, and we select the companies, the kind of companies. There's classification. There's manufacturing, there is trading, there is real estate, there is service sector. Under services, you will find commission agents, you will find some regular service providers, you will find accounting services like that, some thousand services. So in that we have taken IT software industry. Because the client that I am going to do TP document is from the software industry. Search approach. First I will go to companies and sets. All these things I am keeping as a backup. Tomorrow when any questions I am going to tell them, telling that this is how I have done. And then I will show in the spreadsheet. This is what I have done. Companies in predefined sets, all industries, non-financial, select services, other than financial services, information technology, then computer services. You will think, what nonsense is this? How does it matter? Just go, type computer software, select that, no? Correct? We don't know how the database works. You remove any one or two criteria what I have given here and you search. I get 2200, you will get 2600. That is the technical issues that also crop up with databases. That is why to this extent the search should be minute, which tells that how did I search my TP document of comparable companies. You cannot tell that your search is arbitrary. There have been several cases where TP officer has told your method of comparable search is cherry picking. You have taken the companies what you want so that you can show lower margins and then you can defend your margin, and hence because of cherry picking I am going to reject your TP document. For that reason we are going so much detail to tell that what steps are we doing one after the other to get our comparable companies.
Can I use this for BPO?
For?
BPO.
Why not?
Because when we go in this order and search, we are not seeing any BPO. But directly when we give main product or services, there it is given as ITES/BPO.
See here, if you see till services other than financial services, after that there is information technology. There you have the option of selecting ITES. So why are you coming to information technology and then going to BPO? Other than financial services there, last but one. So after that you select ITES and then go to BPO. Then it would appear.
No, there we have only ITES. In that order they are not there.
The BPO is not. That is the reason you have to capture this. And probably add a reason telling that when I went to ITES, BPO did not come. Put that in your work. Same way for STP also, there is a methodology. There are some 1,02,000 companies that are listed in databases. In progress, you have some 54,000 companies. This I am telling 2023 as on 6 November 23. That is the strength of the database. And there is a process that we have adopted. Some steps we have followed after this. So after this, it gives a list of whole lot of companies. So number of companies passing the criteria in progress is 1,485 companies. In STP, we could get 2,460 companies. You have got now? Correct? Run a macro, take the margin, take the average and finish the TP document. Step 1 TP document completed. Agree? Agree? You are doing net margin method. Correct? Net profit is what you have to see. Operating profit is what you have to see. Assume database is giving you the operating profit, no working is required. 1,485, 2,460, common companies I will select only once because it is something like same company may come here, same company may come there also. Both databases, I will eliminate one. I will make it unique list. From there I will take profit, do the operating profit average, finish the TP document, it's over. And this is where they will start giving additional criteria for the search. and you'll understand it. Extracted the following data from ASTP and Progress IQ database. Companies with financial year ending 31st December 21, 31st March 22, 30th June 22, 30th September 22, 31st December 22, 31st March 23, 30th June 23. Why is that? According to the company law only, you need not have your financial year from April to March. It is up to you to change your financial year. So there are several companies whose financial year does not end on 31st March of 23 in our example. And from these, what we have extracted: sales or turnover, total income, export turnover, employee cost, profit before tax and exceptional items for financial year ending 31st March 20, 31st March 21, 31st March 22, 31st March 23. And we have also extracted related party transactions. When we do the comparison, there are several factors that we come across during the finalization of such criteria that we have to eliminate certain companies after we compare them year on year. As a result of that, we take 3 years of the data and then do the search. I'll tell you why 3 years also will come. Filter 1. Financial year ending with 31st December 21, March 22, I mean all that. This filter is applied to select companies having financial year ending 31st March 23, and we have also selected those companies whose financial year ending is on these dates. However, these companies have the data for 12 months, full year. All other companies have been eliminated as the financial data is not available for the relevant period. After we put across this criteria, what happened? You can come to column 3, column 4 now. It got reduced to 811 items in progress, 833 in this time. We went into filter 2. Filter 2 is little legal, controversial and also subjected to litigation. So that I leave it to your legal acumen. In case you come across a better case law, you can use that. Okay. So we have told for companies from 1 to 200 crores are selected. And why is that? Because the turnover of the company that I am doing the turnover for, even if I do the turnover into 10 times, it is having a number less than 200. So all the companies beyond 200 I have left. There are several case laws that are there on turnover filter, including various scales and all that. You can see very clearly. The courts and the tribunals also have read, okay, 10 times the turnover, take it. And it does not make any sense if somebody is making 1 lakh crore turnover, you will compare that to a company which is doing 5 crores turnover. So at least 10 times comparable, 50 crores, okay, 200 crores. You can't go to lakhs of crores. So on this point, we have a perennial litigation between the transfer pricing officer and the assessee for years now and not yet resolved. It is resolved to some extent because in a particular case, the member of the judge would have told, okay, take into 10 times, that is the criteria. And all of us will start following that. Then the PPO will tell, no, that is for IT industry, it is ITES, I don't want to do. One more case comes. There they'll tell, okay, that is appropriate, take for ITES also. Then you are trying to apply for a commission transaction. You tell, for commission transaction, there is no. Right? So that is why I tell it is a perennial litigation. But you have to start somewhere. You can't tell that anyway this is going to be litigation, I will not do it. You have to do it because this is your base for certifying the receiving. So you have to follow this. After this filter, we are reduced to 406 and 447 companies. Then we have taken operating revenue greater than 75% of the total income. Why is that? See, normally you are holding in subsidiary companies you take now. Entire turnover, if it is a captive unit of the foreign entity, the Indian entity is a captive unit of the foreign entity, then its entire turnover is normally from the foreign entity only. And typically it will not have any other income. It will be just cost plus billing, and so much of turnover is there on parent entity, and that is the billing that is coming there. So almost your 100% of income is operating income. May not be so in all the companies that you have selected in this previous filter, that 406 and 407 that we have now. Possible that some of them may have significantly lower operating revenue compared to total sales, total revenue. As a result of that, we have seen as an experience, transfer pricing officer considers, okay, at least take 75% of the total income to be at least operating. As a result, 392 companies, 407 companies, from 406 to 456. We are looking at transfer pricing for an export turnover for our client. But out of the companies that you have selected, many would be domestic turnover significantly. So how significant should be export turnover? So we are taking out of the total turnover, consider at least more than 75% where export turnover is. So it brought down to 164 and 107 companies. We started at 54,000 and 1 lakh, if you remember, that is the size of the database. After 6 filters, you are at 164 and 107 companies. Filter 5. Employee cost greater than 25% of total turnover. At least 25% more than total turnover we need, because we are a software company and predominantly our cost is manpower cost. If you come across any other service cost where it is some other cost and not an employee cost that is sitting your creating, obviously that cannot be compared as a comparison. So they have fixed as a matter of practice some 25%. Okay, at least that much must be there as employee. Profit before tax.
If you inclined to take it 50%, what they take more than 40%?
If you are able to defend your percentage here based on the business dynamics that your client is facing, you are 100% right. There's no problem.
Yeah, but if you won't even be better than at the IT level.
No, see, this is only example. I am just telling example. These are not fixed. I have gone with what orders I am facing. That is my best estimate. For your client, your facts are unique to you. You are able to establish the fact that out of total operating cost, 75% is employee cost. I don't want to take any other company. It needs to be tested. All these things, see, nothing is final. See, the problem is like this. The problem is like this. You are doing some 180 TP documentation. You start taking different positions for each case. You invariably go into different kinds of litigation. At the end of the day, to fight the case, you would have forgotten what stand you take. So we should have some sort of a commonality and a basic understanding. If I take this percentage, irrespective of the stage of litigation goes, I am still able to define my case. That kind of a common understanding we should arrive at in the mind and then start doing those exercises. That is why, considering all this in experience, this 25 is taken. Officer also is taking 25. So I'm happy. Profit before tax. The filter applied to companies remaining after application of filter 5. In this filter, companies making persistent losses are eliminated. That is, company having loss for 2 out of 4 financial years, we have eliminated. We have considered 4 financial years. Out of that, we have seen persistently loss making. In some of the cases, this also has come. We have seen, okay, continuously losses are coming. Don't take this as a comparator. Because finally, when you compute margins, it will have a significant hit. It will come down. Sometimes it can be less than 5. Sometimes it can be negative. I don't know what kind of things comes. So we are giving a benefit of doubt to the department as well to tell that in case it is persistent losses, I am taking it out because it is something extraordinary that is happening. In our industry, everybody is making good profit. So somebody making losses, only that I don't want to hold on to and reduce my margins. So I'm just segregating. We are at 143 and 86 companies. Related party transaction less than 25%. Can anybody tell me why this filter is required? related party transactions less than 25%. You can be louder. Because you are comparing with related party transaction. Again with related party, if you do, it is called as tainted transaction. So we cannot compare related party transactions companies with related party transactions. Correct? Otherwise all TP companies you won't compare other TP companies. That is not the objective. So how much is that? 100%? We don't know. Because some element of related party transaction may be there in all companies. We don't know. So for safety we have taken 25%. So up to 25% you take. I mean beyond 25% you take, up to 25% you take. Because the element of related party compensation, your overall profit is low. We left with 41 and 56 companies after this filter. Function and
also
allocation.
limited by 15%, 25%. Always 15% is always sometimes it is held by this item very commonly. Some of the decisions are conflicted decisions.
I told it is quite contradictory.
In Bangalore also it is.
I cannot tell anything as a rule here, unfortunately. So I am only telling a broad methodology.
Normally 15 or 20.
And what substantiation you are going to give, it is you have to weave your story. Until this is how we have done it and this is what is comparable to our case. Right, no problem. See, finally the verdict is from Supreme Court. And we have gone up to Supreme Court also, although now we are following TP margin 15%, 17%, 18%. When it went to Supreme Court, we were at 10% also. Correct? So, courts that way is reasonable. The problem is the time and the 20%, 15%, whatever tax money gets stuck. That's the problem. That is the reason nobody wants to litigate. So, we are trying to reduce the litigation.
These are the studies basically 15 or 25%.
Trying to reduce the litigation. We are going with what you want. Okay. So, related party transaction filter gave us finally 41 to 56 companies. Next is functionality check. All this till now that you did are easy. Why? Because you are giving a criteria of percentage, value and all that. Software can pick the data and throw the balance companies as an output. Next is more tricky, functionality check. Very tricky. Here is where we have a lot of work to do in TPW. All the 41 companies there, 56 companies here. Assume some 20 companies are common. 41 plus 56, you have 97 minus 20. So unique set of companies, you have 77. For all these 77, we have to test functionality. That is the reason we get functionality at the end as a criteria. If you come at the beginning, you will have to do that check for whole population. You will come mad. For thousands of companies who do functionality. So functionality we keep it at the last. So that on all the criteria we have exhausted and we have very less number of companies to work on. So here, functionality, how do we check? Audit report, nature of business, transactions that has taken place, P&L you will see. You will check the schedules. You will go to related parties, check there what kind of transactions, financing, something like that is happening. Check the cash flow from where to where, what is moving. Then, to each of these companies, I go to their website and check what are their products and services. And mind you, all these things we take screenshots and keep it with us along with. Can you see this? You can see here there is a date, there is a time, right? We take the screenshot with this and keep it. This is TP documentation. Our 100 pages story that we write, everybody will write. How depth we have gone in order to prove what is right is very important. We have gone here, we take this screenshot, which is showing the date and time. Because later when he searches, he'll tell this web page is not there at all. I tell that is not my problem. When I took it, that is what is there. And compare each of these with the company that I am comparing. And see functionally are they same. If it is same, pick up. If it is not same, I don't pick up. Now, what is same, what is not same, as a chartered accountant, I don't know. If you tell C plus and C plus plus, along with other than a digit, an alphabet and a symbol, as a C, I don't understand anything. Make sense? I may be illiterate in software technology, correct? I am good in as a CA professional, not as a tech guy, correct? What do I do? I list all of these, send it to the technical lead of the company for which I am doing TP documentation, and he will confirm to me as a MRL, management representation data. Take this company because of this. Take this company because of this. Don't take this company because of this. He will give a list. So that list, web page, notes, MRL of the tech guy, together I am culminating and finally arriving at what is comparable functionally also, and then listing 4 in progress, 6 in listing. Here is the interesting thing. We took 2 databases. Out of that, we are trying to see which are the common companies. Number of common companies selected in both STP and progress, we have 3 companies. That is 6 plus 4, 10. So 10 minus 3 is 7. So number of companies selected as comparable is 7.
Is there any minimum criteria?
You have Rule 10(1)(ef), and it says, even if you have found one comparable, you have satisfied the arm's length. 1. Even with that, there is litigation, because they go on to tell sufficient companies are not there for comparison. So that is why all this exists.
No, I have to arrive at my median. So for that I am asking, is there any minimum criteria?
Correct, but the point is finally I got one. So now the point is, will you go with median, which is a procedure that a CBDT has given, or will go with law, which is 10(1)(ef), and it is telling you if you have uncomparable, it is up to us. It is up to us to what extent we would like to litigate. Correct? So we will hold there. See, that is possible, but I am not making it too much aggressive to avoid the litigation. We are trying to see what assessing officer wants given, and let us see in that level playing field can we still win against it. Otherwise, I told you, we will go up to Supreme Court, we will win the case. There is no doubt about it. But there is no point. We have to save the time. At least 99.9% of the cases of the transfer pricing get settled at the ITAC level. Because there is nothing more question of law that is arising in all the exercises that we are doing. Although they derive question of law out of this also. But most of it will get covered. So it may take around 3-4 years of litigation.
So if I get 6, is that fine?
That's it. So companies whose details are available for financial year ending 31st March 22 and March 23 has been selected. That is, this note 1 is for this. We took all this, but finally what did we take? Companies which are involved in software development services having turnover of more than 1 crore or less than 200 crores has been selected. Why is that? The NASSCOM, Apex International Body of Software, BPO or ITS companies in India, classification based on turnover as follows can be considered. It's the topmost IT body in the entire country. So more than them, who else has better knowledge to classify companies as large, medium and small? So I've gone with this definition. So beyond 200 becomes large. So in our, this one we are still insured small and medium is considered 1 to 200. tested party name will fall under first category, that is small size firm. Which is the tested party? The company for which we are doing. Can tested party be different? Your client is ABC Software Private Limited. You are testing the margin of that company and telling transaction is a transfer. Can tested party be different than this company? Something else? Can I test some other company? Law allows it and tells any of the constituent companies that are involved in the transaction, you can make that company the tested party. Now you had entire one transfer pricing and all these problems on one side. And all these things you are shifting to another tested party. And where is that tested party? It is in some other country. Foreign country. Will you apply these criteria there also? Few may apply, few may not apply. And what is the TP document methodology normally that they follow in that country? Which is the database that they take in that country? How are the TP assessments done in that country? What is the normal legal interpretation as far as these transactions are concerned in that country? Tested party different. But based on that country, I am able to substantiate international transaction is at arm's length. So there cannot be a case where something is at arm's length to one party and it is not at arm's length to another party. And hence, different tested party of the same transaction can be considered for doing the arm's length pricing check. Okay. So US, what do we do? Throw as STP, all that won't work. All there, the Thomson Reuters come, Bloomberg will come, a whole lot of things, right? We do take help of some associates there and they help us in such cases. When do we do it? We do it when it is clearly known that if I take any of these methods, I may fail. Point one, as a strategy. But assume there are real concerns that the database here is not giving what I want. So I have a possibility to change the tested party. So we saw the term here, so I'm explaining you what is tested party. And rest of it, why 50, why 75, why 25. So once we are through with this, we go to the spreadsheet and see how it works. So in the first sheet we have mentioned here search of comparables. Here again we have told how we have done it. Database used. Which is the version? There can be a version updated of the software. Officer will come and use. I also used STP 11.1.1. It gave different companies. Well, based on the don't reject the TP document, when I did, it was 11.1.0. So to that extent, everything is getting mentioned. Database updated till search of comparables for. So again, same thing. I'm just showing in the spreadsheet. And as I told you, these are the screenshots that we have taken. To your right, bottom side, you can note down. There is the date. There is the time. Mandatory. See, you may say all these things are very trivial. You actually don't know when this will come handy to you in litigation case. So better we follow few things we follow blindly. We don't know when this would be. So we have filter one, where you had this number of companies. Based on that, we ran the software. It shows from 2,460 companies out of 54,000, out of 1 lakh, because this is STP database. Filter 2, turnover, 1 crore to 200 crore, came down to 830. Filter 3, income criteria, where 75% is from software development service, 447. All this, we are giving the command in the database itself. It throws a report, we export, put it in a sheet. Give the command, it gives the command, copy it, put it in a sheet. Okay. Export. Employee cost. 107. PBT. That is persistently loss-making companies we have eliminated. Correct? 96. Left with 96. Related party. We left with 86 because 10 are more than 845. Functionality. Those we have.
So for related party, whether you combine the income expenses together or separate.
Transactions. Transaction value. Cost transaction, income transaction. So based on functionality, finally selected 6. You can see 6. Now we have a list of companies in AST. Same thing is done in Lotus. You understood the amount of effort that goes to it. Now, you change any one criteria in it. It's almost that you are reworking the entire thing. So it is possible to keep you busy for a same client for entire 1 year. You meddle with any one factor, you can keep doing till you document it. That is why all these things as a strategy, we sit and finalize for that year. Are these criteria fine? So till October, the case laws that have come, the team will screen. I cannot read it. I have seen landmark few, but you don't know what are the things will be there. 10 people will sit and they'll screen all the case laws. They'll see based on our earlier workings, currently are there any new ways of doing things, are there any new judgments that have come? Can we adopt those in our TP document methodology so that we also remain current? Right? And then reach here. So, in case I don't do that and somebody points out, I start doing this again, there is a madness. There is no end to this. So once this is done, we have 2 sets of comparables. Serial number 3, I am not going too much into detail. It only says the heading, I am reading it for you. Business profile of IT. That is of the company and also of the industry. We just made a notes. The software industry margin workings. So now that we have the final list of companies, can I do the margin workings for those? Till now we have not done the margin workings, mind you. Till now what work we have done is only selected the company. We did not do any work. So now we took the margins by taking their profits, operating profit divided by operating revenue. And that gave us the operating margin. So here out of 7 companies, this is how it stands. We have Athena at minus 6.7%. You told negative should not come. Why it is coming here? Any idea? Anybody can tell me? You told loss making should not come. Why it is coming here? Consistent losses only we have eliminated. Something is inconsistent once in a while losses come and that year it is a loss, I have taken that. Out of 4 years, 3 years was profit, 1 year is loss. Normal operations. So I have taken that. It is not persistent losses. So I have taken that. Then you have 0.23, 0.37, 0.68, 7.5 and 8.46 for Similarly, for Progress, we have taken the working class. Normally, we feel first priority is given to Progress. There is always you see that side, telling that there is an inclination to go to one database. ASTP also we go because what if you don't get anything in Progress? Somebody is there to save us, so ASTP is there. So here we have done the weighted average, serial number, and you can see here this is sort in the ascending number. There is a result that is there. Out of this, which comes to 35 percentile of the line items, 65th percentage of line items. We are doing the median calculation. That is purely formula. I will not go into formula. But the people have taken care of it, but I am telling logically. So median we have arrived. So you can see the median here. People at the front can read. 12.62%. So the profit margin of the company that we are handling is say 12%. Can you tell me what should we do? The profit margin of the company that we are doing TP is say 30. To tell me what we should do. The margin is let's say 12.62. You let me know what we should do.
Arm's length.
See, earlier 92C3 used to tell us you have a bandwidth
5%.
of 5 which became 3 later. Then the concept of median came. So when 3% was given, we used to fall in a range until that arm's length established. But once this median concept came, we are not able to use that 3% criteria. We have to go with median, and there is no other objection that the client raises on your comparability of this mechanism, and he agrees. Go to tell him, boss raises 12, here it is 12.61. Do a primary transfer pricing adjustment in your tax computation. 0.67% of your operating cost, offer it as your peak. 0.67%. Minus 13. You can't say, department, give me back my tax. That is it. What is tested is transactional value. Transaction value, you have established it as arm's length, so we will not ask you any more questions. The department interest tax. Right? So that is how the conclusion happens as such.
Is there any mandatory filters?
Nothing is prescribed in the law. Nothing is prescribed as a mandatory filter in the law. By reading the law and looking at the business dynamics, officers have come up with ideas having filters. Tax consultants have come up with ideas telling that why can't this do this? And right now from 2002 to 2024, this is where we are there. After that, it depends what new idea you can come up with. What if somebody is ready to agree to that? So that's why I told this is not fixed. The activity document is always WAP. You can always improvise it. We have to see to what extent we can run our brains and make it relevant. Right, so this is how the workings end. With that, the TP document does not end. This is only the starting point to do the TP document. Correct? Just one second. So this is transfer pricing document for a software company. Financial year 22-23. Here there is one important thing we have to understand. I have written here by the firm name. TP documentation is a business document where you are analyzing, doing a lot of steps, then substantiating, choosing the methods, preparing a document, and making it a basis to sign the Form 3C. We have a code of ethics problem. What? TP document is a responsibility of the assessee. 3CB is the role that chartered accountant has to play. So TP document I am doing, 3CB I don't sign. Now along with transfer pricing, one course of code of ethics also completed. Okay, so in this document we have executive summary, which normally gives introduction, scope and purpose. What is the summary of this document? Industry review, about which industry did we do all this analysis, and we are presenting this document, and give some information about the industry. In that industry, what is happening, what is not happening. These are all reports that comes from websites. You go to NASSCOM, you go to some chamber of commerce, you go to all this you will get. But what is relevant to you, take it. Don't take an information which is detrimental to you. We have to be conscious on what we are putting there, what we are not. Company and group analysis. Which company I am doing the TP document for? It belongs to which group? That group, what business is it doing? And why are these related parties at all in the first place? So we are starting 92A1A or 92A1B or 92 to define on what basis these people become associated enterprise in the first place. Once we do this, we do the functions, assets and risk analysis. This is a very, very tricky part. We can write all the theory that is available in the world. Whether it is the CAs or the department or the tribunals or the courts, all of us equally fail quantifying. That is the reason in several judgments you can see the benefit of these adjustments, you can't see more than 0.5 to 1%. Risk analysis. I am saying I don't have customer risk because I have single customer. Who is my customer? My parent entity. So, if I have multiple customers, the customer risk is high. What if all customers go? Or 50% goes, 50% here it is guaranteed customer. Where will he go? 100% is there. He can't go anywhere. Because he wants me to work. That is why he has formed my company. Correct? So, customer risk is high. When risk is high, will I price more or will I price less? To cover the risk minded. So obviously I charge more. If the risk is less, I charge less. But you are comparing with uncontrolled transaction. In uncontrolled transaction, the risk is high. Controlled transaction risk is low because I am not dealing with only him. So I want to take the median and reduce 25% as single customer risk. So according to me, margin is 9%. You are able to understand from where I am coming from, you are able to understand. So that is the intent of getting this into the statute books in the first place. I am doing only software coding. Right? Who is deciding which business we should do? Parent company. Which customer they should work for? Parent company. How much capital should we invest? How many employees should we have? How many countries we should operate? How many years, how many people we should have? I didn't do anything of that. That is not my function at all. So out of 6 functions I you told, or 7th is say software coding. Out of 7 functions I am only doing 1. So I want to tell 1/7 of the margin I will remove. So you may tell, how is it possible? You have to see the importance of the function and assign the rate. You are also right. Can you see the subjectivity now? We are going into litigation area where
You want to give a number and tell that based on it I'll reduce the comparable margin, but the officer is telling, no, I can't give you. Or even if you go to the court, we are able to see only adjustment of 0.25, 0.51% max. Not significant differences. So FAR more or so has become some sort of a theoretical exercise, but yet it is important because section 92D talks about it, rule 10D talks about it. This is a mandatory information to be captured in the TP document. But in future it will be used for what I don't know, so better still keep it. Assets analysis. I don't need asset at all. You are telling you are using laptop. I don't want to own them, I lease it. What is my asset investment now? Nothing. What is the asset loss? Zero risk. So why should I charge more? Correct? It can be several reasons to ask the assessing officer that my margin should be low, it should not be so much. Margin is high, tax is high, margin low, tax is low. So we are always, we are trying to see can the margin be. That is a general connotation, it can be wrong also. You may have scenarios where the margin is supposed to be high for some other consideration. It may not be tax calculation. Right? But here we are talking about tax. Agreement with associated enterprise. One of the important component of the TP documentation is the verification of the agreement between the related parties. TP agreement becomes your primary document even if you want to raise the first invoice to your parent entity and get the payment for that, because forget about the entire tax law, banker is going to ask for it. So any TP exercise you are starting with TP agreement. That you have made part of the documentation also. And there you are telling overview of the agreement, nature of transaction. You are making part of TP document. Transfer pricing regulations. We are telling the officer, in case you are assessing my case, don't look for transfer pricing regulations everywhere. I have all the transfer pricing regulations in one place. So it is here. Economic analysis. Selection of tested party. Selection of most appropriate people. Selection of tested party. Did I take my client as tested party or the other party with whom he transacted as the tested party? And why? Selection of most appropriate method. We have CUP, resale, cost plus profit split, transactional agreement. Which one did we select? Which is most appropriate in the given circumstances, and why we finally came to TL. Other method we did not go into too much of detail, just as a passing reference for you to understand. In some businesses, there will be certain components which may not be easy to finalize the arm's length based on say TNMM or any of the methods. Because TNMM also has some issue in those cases. For example, functionality can be different. You got 100 companies, finally functionality you tested, it becomes 0. You cannot rely on TP document, not possible. We come to other method and tell me there is a adjustment we have done for one of these methods and adopted that adjusted method as a method to substantiate our transfer pricing. So classified it as other. Or there can be transactions where margin may not be important, but value may be important, or percentage may be important. So we will go with something called a royalty source database. Download all 1 year royalty agreements that are there. Make list of them. See functionality. Remove what is not royalty that we want. Take only those which is near to us. Take average of that. That becomes other method because I am not using any of those. Price, it is not price. Margin, it is not margin. It has to fall somewhere. It is falling there. This is the reason we in India we have that other method coming. They can defend anything. You can ask them why other method, they will give you the story. Because this is why other method is there. The most appropriate method, how did we say?
For other method, we don't need the comparison.
You will provide comparable is there. See, if you don't have anything, how will you substantiate? Don't get confused whether comparable is there or not. You have to be clear using the comparable, which method did you use? Comparable is valid. Without that TP cannot happen. Correct? Without comparable, how will I conclude the TP? I am not able to conclude the TP. Most appropriate method, we will go to each of the methods and tell why it is not applicable, and then choose the method, say TNMM, and tell why this is applicable. And we conclude. Selection of profit level indicator. Profit level indicator, abbreviated form, we use as PLI. In TNMM, profit level indicator is operating margin. Operating profit divided by operating cost. But you are testing an expenditure transaction and margin is not helping you under TNMM. You want to go under other method, but a ratio you have to give as profit level indicator, you take something called as a Berry ratio. In Berry ratio, it can be anything that is related to something else in the period. Normally, the commission we relate to savings. Depreciation we relate to asset. Correct? So, like that we relate and then take that ratio in all the comparables and compare them until it is advanced. Right? So, profit level indicator is that. It can be operating profit, it can be gross profit, it is those. Application of weighted average range concept, arm's length price, economic adjustments. Economic adjustments are again risk adjustments, functional adjustments, assets adjustment, working capital adjustment. My client is always taking advance from its parent entity. There is no sundry debtors. It is always on credit side advance receipt. You have taken all comparables. They have debtors. They have to fund their debtors. So there is a working capital. On working capital there is a working capital loan. Where is that cost for me here? It is not there. So to the extent of working capital adjustment and the interest factor there, give me a reduction of the margin that I have to take from the comparable companies. Can be a method to add. Even for working capital adjustment, unfortunately we have seen the adjustment has not been more than 0.51 and all that. Because CBDT follows in formula. If you put that, nothing comes. That is how they have designed. Because to put that you need some 3 years of data. And invariably the amount of workings that we have done, we have never been able to get some favorable percentage. But that is there. I am trying to explain to you what do you mean by economic adjustments. That is the adjustments. Comparable search, database and their limitations, computation of net operating margin, determination of weighted average margin, determination of arm's length range, annexures, appendix. We have some provisions, we have workings, etc. coming later. So, enter TP document. Comes with full amount of data. So this is some 80-page document. Unless some size is there, you won't get fees. And look at the means. You are giving 80-page document here. How about the comparable search? The amount of effort that is required for that. So if there is a mechanism available, you can take all those Excel sheets, convert them to PDF, give it as a workings to your clients, tell them this is the effort that is involved. Unless you show the effort, there is no fee. It goes on. And we can see what is there. So annexure B. We have told what is the company name and about that company. The final comparables are there now. Those should be handy at any point of time because the case is not going to come immediately. The case will come after 2 years. So at that time we can't keep searching. So some of the strategies, okay, about all this thing, let me capture here only and keep it in place. Ready reference. Of course, this is all the workings. And it says how we have arrived at the operating profit margins. So with this, the TP documentation yes, but the topic does not. We'll see a few more things.
Can officer reject the documentation just because we have used capital line database?
No,
But
he has to give the reasoning and then reject. The filters that we saw, that can be one of the basis for rejection. Based on capital line data. So publicly available database. And we have not done any cherry picking. We have done that 20 steps analysis to arrive at the final compartment. Also done functionality analysis. On what basis will you reject capital line? And capital line people have been using from the time I am born.
So TP also is using this capital line process.
TP also is using it, according to capital line. So, for, see, I cannot again tell this is final, but food for thought, these are normally accepted most appropriate methods. I'll just read. Cup is used for transfer of goods, provision of services allowed because hourly rate if you get possible. Intangible cases, cup possible. Interest on loans, cup is possible. Resale price, distribution business of goods, RPM we can use. CPM, cost plus services. Provision of service allowed, joint facility arrangements, we are sharing rent. Transfer of semi-finished goods, I can use cost plus. Long-term buying and selling arrangements. Semi-finished goods cost plus, because final price I am not able to get, semi-finished goods will buy. So, in these cases, CPM is allowed. Profit split method, integrated services provided by more than one enterprises. Transfer of unique intangibles. For this I can use profit split. Transaction net margin, almost for everything. Almost for everything. Except the specific things like royalty, interest and all that. Normally we don't use because there is separate databases available. They also may go there and then get it.
So can you give an example of the unique intangibles?
For
Unique intangibles.
transfer of unique intangibles. That is, right now, you have new method in which your car can run. He has another nice formula how your car can run. Is it unique? Your intangible quality wise it is unique, but in the market it is not unique. It is car technology. Right? Somebody is coming with one more technology where the vehicle is going to move not on the road, it will go on the air, but it is not flight. The technology, anybody else is having it at that time? Unique intangible. So anything that is unique intangible, we can try to use the profits. 92E, only a reference I drawn. Form 3CB, transfer pricing report should be filed 31st October of the assessment year. We have to file it. 92D talks about maintenance of the records. And the provision says every person entering into international transaction or specified domestic transaction as specified by CBDT, which is known as TP study report or local file, has to be maintained. Now in our entire discussion till now, we spoke only about international transaction. We did not talk about specified domestic transaction. Now what is specified domestic transaction? Erstwhile we had a very comprehensive coverage of specificity where transaction between related parties within India, if that value was more than 50 crores, they also were subjected to transfer pricing compliances. Now that has been eliminated we have new provision that has come, either section 10A or 115 BAA that you use as a manufacturing unit. In those cases, you are using those provisions, you are a related party. In those cases, they want the related party transactions to be covered under transfer pricing because there is a chance that the cost of the low taxed company can be moved to the cost of the highly taxed or shifting of the profits. So by that, if I show more profit in low percentage, then I'll be able to say more tax. So there they have brought in specified domestic transaction. If SDT comes, same TP documentation has to be made. Then point number 2, constituent entity of an international group shall keep and maintain such information and document in respect of an international group which is known as master file. Apart from Form 3CEB, which is our transfer pricing report, to be signed by Chartered Accountant. 3CEAA has to be filed in case of master file reporting, where there are two parts. Part A is there, part B is there. If some of the criteria does not meet, we file only part A. If the turnover criteria hits, we file part B as well. This is latest added in the TP. Latest in the sense at least some 6-7 years. This is already done. Now because of this, there is a reason why either the CA or the officer is able to get the financials and the other information from the group that is there outside India. Otherwise, normally only India transactions people used to do. They don't supply anything. But this has come. Now they have to start sharing more information on the foreign entity. The constituent entity is required to keep and maintain information document irrespective of the fact whether or not any international transaction is undertaken by such constituent entity. Furnishing of prescribed information and documents. The assessing officer may require any person referred to furnish TP study report within 10 days from the date of receipt of notice. This is where the problem is. Now the client that is coming to you, please tell him, whenever the notice comes, at that time you prepare the TP. Now the problem is, to how many people in a 10 days period you will be able to prepare the TP. So as a professional also never agree to that. You tell the provision clearly tells within 10 days the assessing officer can give you maximum 10 days to produce this. We can't do circus at that time. November we have done all our IT returns, December, Jan we should close the TP. That is why I am showing you this provision. 10 days, what will you do? There is nothing absolutely that we can do here. Information provided in TP document I have already done through. In PPT it will be there, you can always refer it. It will be uploaded in there. Bangalore branch code. You can take it from there and pass this on. What we have already seen in the TP document I will not go with. See, profile of multinational group can be like this. Just 30 seconds on this. Industry overview. This could be material published in business newspapers, trade journals, magazines, all of which provide macroeconomic perspective to the industry. Instead of doing all the Google, go to these. I think we find a lot of data in this websites. Anyway, you will get the, actually, no point in writing these down, that is okay. All these things we can actually need to be documented if you are analysis. Functions analysis. You have R&D, manufacturing, marketing, procurement, warehousing, sales, distribution, after sales, invoicing and corporate services. So many functions are there. Which group, which constituent of the group is doing which service, my God, and how much profit we should attribute to which function. It is like, again, auditor. Again, auditor. You probably are collecting more data than what you normally do. We prepare a FAR summary and will tell R&D what is XXX there, that is the place where we do that. In US we don't do, India we don't do, in assessing company we don't do, in France they are doing right. Design selection, trademark and design registration there is. Procurement who does, warehousing who does, manufacturing which entity, marketing in which entity, sales in which entity, after sales in which country, corporate services in which country. Trade receivables, that is with external customers. Where is the trade receivable? Inventory, which company, where it is like, property. So you can see the functions can be no end. Risk, business risk, market risk, inventory risk, credit risk, forex risk, product liability risk, service failure. Who will bear all that risk? Then we conclude. This I have already told that 1 crore limit. Information to be supported by authentic documents. So information to be maintained by SSCs to be supported by authentic documents. These may be like official publications, reports, databases, market research studies, technical publications, price publications, market quotations, published accounts, financial statements, agreements, contracts, letters, correspondences. Email may become a proof, correct? Documents normally issued in connection with various transactions. And it says you should maintain the documentation for a period of 8 years. For 3C EAA that I mentioned, the requirement to file the master file comes if the consolidated group revenue as per the consolidated financial statement of the group is 500 crores. And the aggregate value of international transaction is more than 50 crores. Or in case of purchase, sale, transfer, lease, use of intangible property during accounting year as per books accounts exceeds 10 crores. Then entire 3CEA gets reported. Assume only 50 crores satisfied, 500 is not there. You find only part A, part B you don't find. Contents of master file is there. I would not read it for you, it is self-explanatory, you can go through this. Penalty is important because wherever explanation does not work, fear works. So normally if documentation is not maintained, 2% of transaction value is the penalty, up to a maximum of 2,50,000. But for 3C EAA, if you don't do, penalty is 5 years. Benchmarking I don't go into, we have already seen. In the same PPT, in slide number 73, I have listed which database we can use for what. Domestic databases, we have Progress, Capital Line, Annual Report repositories like MCA, ESTP. Foreign tested parties, there is GS Prime, Amadeus, Osiris, of course there is Thomson Reuters, you have Bloomberg, all that. Financial benchmarks, interest rate, BMs and guarantee commission benchmark, Moody's, S&P, Loan Connector, Bloomberg, all this can be databases. Of course, earlier for interest we were seeing something called as LIBOR, the London Interbanking Operating Rate. But LIBOR is no more there. It has now become SOFR, SOFR. So that is the new rate that is running across the globe. Royalty benchmark and royalty stat, KT Mint, LexisNexis, any of these databases.
Going to the previous one, saying only capital line can you detect. Let's say the reason he gives is when you are giving a comparison of two databases, one database had a lower population compared to the other one, and that itself be the basis for the officer to say this, the database that you used has a lower population and reject the whole study.
See, right at the beginning, this problem is there. That is the reason we are using at least 2. But this is genuine problem. Legally wrong. He cannot do that. He is doing to irritate you and the client. That's all. Because I very clearly told her rule 10 1EF tells one comparable also transfer price is established. Nobody can question. But only thing is you should have followed the process completely. You will fail if you go to Supreme Court. The problem is the time. So that is the reason I am telling you the entire TP document I have prepared is based on TP order. Now tell me what you will challenge? Only functionality will challenge. You will challenge turnover. Apart from that, it does not have anything to challenge because I have taken this percentage. And that turnover and functionality invariably, 100% of cases we have won. We have not lost it. Of course, many times I that, I understand, but still.
Sir, if my margin is lower than the arm's length range, so I'm trying to bring it within the range. For that, I'm eliminating the filters. On that ground, I predict it.
Obviously. Now see, if it is a relevant filter, and if you are removing the filter itself, that is not a right method to do it.
No, that particular filter is not relevant to my.
If you are able to prove it, I don't know about it. But looking at that, do you think something can be not relevant? Employee cost is there, operating revenue to total revenue,
Usually-
export turnover to total revenue.
We add up a few more filters to this. So in that case, if it is not relevant to my.
Possible. You have to tell your filter why it is relevant in your case. Bring out that, let the documentation be strong because at first level he will not accept. Most of the times I type only. DRP is a TRP, CATRP is a formality. 3 commissioners are sitting. Assessing the order of their own junior. Why will they go against them? Of course, they may give some inputs telling that, okay, in this case, this we accept, this we don't accept. But by doing only that part, your margin will not change significantly. So DRP CATRP has been normally not affected. 99.9% ITAT, the case closes. In comparability, I will remove landmark judgments. It is all same on what all we have discussed. I am talking about different financial year, functionality filter, elimination based on turnover filter, about the TP document. Some of the landmark judgments are part here. You can copy this only and put it in your submissions. It works. Assessment of transfer pricing in crux have given you. Base BEPS action plan is the latest development from the OECD. Base erosion and profit shifting. This they have brought in as a separate action plan altogether. India is, of course, India does not sign anything, but it will adopt it, all inclusive. So, from that angle, it is important to understand this as well. There are some important action plans which are relevant from the perspective of the transfer pricing as such. So, just covered them. You can refer them. Action 8 is important, it talks about intangibles. Action 9 on risk and capital.
Where to look for the in the Bangalore branch?
Bangalore branch, it will be there in the, what is that? Material.
Resources.
Background material.
And the resources.
Resources, background material.
that will not be-
Other high-risk transactions, Action 10, Action 13, TP documentation. Impact of BEPS on TP, all this I've covered. You can just refer that. With that, we will end the session. Probably we may, I don't know if we get another chance, we'll take one thing and go deeper in that. Right now, the job was to explain the overall things. I hope that we could. Thanks so much.
One question. If a safe harbor is there, and also documentation is mandatory.
Yes, let me tell you. Forget about safe harbor. You have APA, Advanced Pricing Agreement, based on which you have a 4-year rollback, 5-year forward. Based on that, the margin is finalized, contract is signed between CBDT and your company. Even then, 3CD mandatory, TP document mandatory. Reason, whatever is there in APA, are you following or not? that has to be checked by the child. Safe harbor. You have to prepare the TP document, go to the assessing officer, tell all these conditions we have satisfied. This is the document that is substantiating this. Based on that, he will agree, okay, go with 17%, go with 18%. So TP document, 3CB, mandatory, with or without safe harbor, with or without APA. Clear?